The broadcast is now starting. All attendees are in listen-only mode.
All right, hi everyone. So I'll just wait 1 minute for our audience to finish joining before diving into the webinar. So just hold on for 1 minute. Okay, I think our numbers are looking stabilized, so I will jump right into it. So good morning and good afternoon, everyone. Welcome to the very first webinar of CIAC's 2022 webinar series. For those of you who are new to our webinar series, my name is Danielle Morrison. I'm a policy analyst here at CIAC, and I will be your moderator today. Before we begin, I'd like to acknowledge that the CIAC offices located in Ottawa are on the unceded, unsurrendered territory of the Anishinaabe Algonquin Nation. We are grateful to have the opportunity to be present in this territory and also acknowledge and appreciate that there are a number of participants coming from other traditional Indigenous lands across North America. Today, we are joined by Dave Cherniak, Senior Policy Analyst at CIAC with expertise in business and economics, who will be reviewing the 2022 outlook for Canada's chemistry and plastic sectors. Building off our strong recovery from the COVID-19 pandemic in 2021, the question remains if our sector will mark a full recovery to pre-pandemic levels and so show just how resilient we can be. We know that key trends in policy areas such as climate change and transportation will have significant impacts and will be top of mind for CIAC members in the year ahead. So we do want to make this webinar more of a conversation, and we'll be reserving a good portion of our time for interactive polls and questions. With that being said, as usual, you've been placed on mute for the duration of the webinar, but please feel free to submit your questions in the question tab throughout the webinar, and the earlier the better, so we have more time to kind of triage through those questions and address them efficiently in our Q&A wrap-up session. The webinar will also be recorded and will be made available afterwards through our YouTube account, so do feel free to share that with anyone who is unable to make it today. I know I'm really looking forward to hearing what Dave has to share, especially given the number of developments we've seen in the first few weeks of January alone. So let's dive right into it. Over to you, Dave, to provide your analysis.
Hi, everybody. Thanks for joining us today, and I look forward to taking you through this. A very quick outlook, or a very quick heads up for you. We have posted the 2022 Outlook, the official document, to the website just a few moments ago. So please take some time after our chat today to go through it. And as always, I'd really like to hear any feedback you may have and any comments or concerns. For the duration of the webinar, I am just going to close my webcam off just to ensure that we stay connected to the internet through this. I had a little bit of a traumatizing experience last week, so just want to make sure we stay connected today. So with that, I'm sharing with you today the 2022 Economic Outlook for Canada's Industrial Chemistry sector. But really, before we get started on the outlook for this, we kind of have to take a step back and look at where we really finished off 2021, what kind of came through 2021, and where are we going through there. So, where did Canada's chemical sector end at the end of 2021? What I would like for everybody to do here is to kind of keep three things in mind. The first thing I'd like for you to keep in mind is a full recovery from COVID. I want you to think about like the activities that you went through that, you know, kind of demonstrated that you were kind of fully recovered from this. Whether it was getting outside with your friends to get on your bikes, getting out camping, whether it was frequenting your favorite restaurants if you're in Ontario and Quebec via takeout for a good chunk of the year, and keep those sorts of things in mind, because a big chunk of the chemistry sector in 2021 really, particularly those for direct-to-consumer use, think packaging, cleaning products, home renovation as well, those really did see a full recovery from COVID throughout 2021. I also want you to keep in mind a partial recovery from COVID. So think of the things that you really wanted to, or maybe you only ended up doing kind of sporadically. Myself, I did manage to get away for a little bit of a vacation last summer, but I didn't get overseas. I didn't get back to Europe or over to a couple of Asian countries that have been really on my list. So keep those in mind with partial recoveries. Think about how perhaps in the fall you finally got back to the office if you were like us in Ontario and Quebec, maybe a little bit earlier for those folks in Alberta or British Columbia. But think about those partial recoveries as well. And then I think it really does, it really is worth saying that we got to keep in mind storms with long impacts. Not just the storms that we saw last fall that dropped so much precipitation in British Columbia, but really going back to last February, roughly from couple of weeks right now, but last February, where we saw Winter Storm Uri significantly impact chemical and oil and gas production in the U.S. Gulf Coast. We got to think about Hurricane Ida in the late summer, early fall. Again, huge impacts on chemical output. And then we have to think too about the arid summer, the truly hot and arid summer that we saw in Western Canada that disrupted transportation networks. I want you to keep these three things in mind: the full recovery from COVID, the partial recovery from COVID, and then a lot of the weather impacts that we saw too. These sorts of things, because of the reliance on a very sophisticated and increasingly efficient transportation network, these things are really going to drive our discussion. What you'll see on this slide here is really just our year-end estimates through December of the performance of Canada's industrial chemical sector. As you can see, overall, it was a pretty good year. There's no two ways to really discuss that otherwise. When we're comparing back to 2020, that's always a little bit tricky, but as you can see with the center column here, a huge outperformance, not just in resins that we've talked about quite a bit, or even in basic chemicals, but really outperformance across the entire industrial chemical value chain. But 2020 offers pretty difficult comparisons. We did have obviously the shutdowns of the economy that occurred in the spring of 2020. We did have a very slow return to normalcy and a lot of downstream manufacturing. So what I've done to the right here, these are comparisons on a dollar basis with shipments to 2018 levels. That way, it provides a little bit more of an apples to apples comparison when the economy is operating closer, but not completely back to normalcy. As you can see, with 2020 levels, with 2018 levels, that resins and rubber shipments did continue to outperform. And we're going to talk a little bit more about that. Industrial gases as well. Think back to maybe you enjoyed one or two White Claws like I did over the pandemic, but think about how industrial gases really play a role in consumer goods, those sorts of things. But then I want you to really think too about the partial recovery. Think about the things that we haven't quite got back to normal yet, particularly things like return to offices broadly across the economy, and not just here in Canada, in the United States too. Think really the large population centers, whether those are New York, Los Angeles, Toronto. We know that throughout 2021, we didn't really see those sorts of activities completely return to normal in these heavily populated areas. And that's why you kind of see here in organic chemicals specifically taking a little bit longer to get back up to speed. Their products kind of get into those sectors that haven't quite recovered a bit more, and we're going to talk about that a little bit more in a second. But one thing that I would like to caution here is that we use shipments as kind of a proxy for revenues for the sector. Shipments don't tell you the whole story. These are dollar values. They don't particularly tell you anything related to volume. In that vein, to keep in mind, pricing impacts do have a pretty big role in what we see in end shipment levels. When we look at some of our other proxies, whether that be GDP or just rail movements, we see volumes in chemicals kind of back to the norm almost. Again, we're going to look into that partial recovery in a second. Volumes getting really back to normal levels, but that also kind of running into the maximum output, if you will, of Canada's chemistry sector, and a little bit more on that. So just to kind of highlight this a bit more, I'm going to bring up a couple of specific graphs here. I want you to take a look at this. These are shipments for resin and synthetic rubber products by quarter. As you can see, throughout the year, beginning right in the first quarter, but really picking up steam in the summer after the impacts of Winter Storm Uri in the Gulf Coast really started to be felt, that resin and rubber product shipments truly outperformed this past year. You can see whether it's on a quarterly basis, whether it's at the first half, 9-month, or annual levels, that subsector really did have a strong year. It's no coincidence they're also closest to those fully open, fully recovered from COVID trends that I kind of discussed a few slides ago. If we look at inorganic chemical shipments, on the other hand, we can see here that the recovery has been quite a bit slower. And that isn't just from 2020, 2000 levels, it's significantly lower in some of these cases. What we're looking to see here in 2022, as we get back to more normalcy, as we get out driving a bit more, as folks take to the skies for vacations, as we get back to the office, schools, as we get using a little bit more paper and those sorts of things. That's the expectation now that the inorganic chemical subsector here will start to see their boats lift as well. It's really about moving from that partial opening stage really to fully recovered from COVID. So again, just to very quickly recap, 2021 ended quite strongly in comparison to recent years. There were a few subsectors that substantially outperformed, and there were a few that haven't quite caught up yet, just owing where we are in the economic reopening. So a pretty strong year. Pricing influence is definitely having an impact in some subsectors, but also volumes really kind of reaching back to what we consider almost full output. And how does that really set things up for 2022? Well, I think the big theme really is the continued emergence from COVID in a fully economical sense. Obviously, we're back a little bit of a step here with the outbreak of the Omicron variant, but we've started to see over the last few weeks that those trends are really starting to improve. And as we look forward a little bit more, getting outside of this variant, really kind of emerging a little bit stronger on the economic front. And that's a story I'd like to tell a little bit more too. There really are strong economic tailwinds for the chemical sector, but also for the economy more broadly in North America, in Europe, and then to a lesser extent, I think in Asia, just because there's some specific issues in China that we could talk about later perhaps. But the economic backdrop to 2022 is still quite strong. Whether that is on demand for physical goods, think automobiles, durable goods like appliances, building materials, very strong tailwinds. In fact, we're still outperforming in 2022, even as we eased off from peak growth that we might have seen last year. We're still above trend, both in the United States and Canada, significantly above trend before COVID. So, some really strong tailwinds looking to push demand for goods and, as an extent, chemicals as we move into 2022. Also, 2022 is a big year for the chemistry sector in Canada broadly. We're seeing investments that have been under construction for the last several years in Alberta and Ontario finally moving into the operation stage. Those should take place throughout the second half, late first half, second half of 2021 or 2022. And that's really going to help bump up that whole productive capacity of the industrial chemical sector. So really exciting to see those come through. And when we kind of take everything in whole, when we think about inorganic chemicals and the sectors they contribute to, particularly refined fuels, paper manufacturing, oil and gas development, we're really hoping to see those catch up to some of the sectors that have outperformed, and the continued economic strength acting as a tailwind for the sectors that have performed well as well. What does that mean? That means we're expecting from 2021 levels sales growth in and around 3 to 7% this year, largely kind of tracking the economic prospects of North America. Now, there's a couple of components to this. I don't think it would be particularly, I think it might be a little bit ambitious to project the same sort of price increases that we've seen over the last little while to aid sales. So that's really not what we're looking at too much. We do think prices will probably firm up for some products, maybe decline a little bit for others, but overall, the demand for chemicals will remain strong in that regard. Also, as we think about these investments coming online, those will increase the overall capacity, and it's a little bit unclear on how that'll translate into increased sales and growth, but that will materially impact the output of Canada's industrial chemistry sector. So again, as we look to 2022, kind of a range there, just depending on how the economy fares, just depending on how supply chains work, but something in the order of 3 to 7% sales growth. And this kind of brings us to our first poll question of the day. I've kind of just given you the background there on where we see the economy going, the sorts of drivers that are really looking to push things, and where we see perhaps a little bit of softness. And we're going to talk about those a little bit more, but just given what I've shown you, given what I've mentioned about the growth range that we're seeing, what do you think? I know there's a lot of members on the call today, and we'd like to hear from you in our totally anonymized poll here. We've got 5 choices. Do you see things better, slightly better, significantly better, worse, or flat. We'd like to hear from you, and we're going to come back towards this at the end of the webinar and kind of dive into what you think and what you're seeing with your operations as we go through the year. Now, in any year, there's always economic opportunities and economic challenges. Like everybody, I like to get the challenges out of the way early, and that way we can really focus in on the opportunity that's coming down the sector as well. I think that the biggest economic challenge, to nobody's surprise, is of course the trajectory of the COVID pandemic. Again, I think the impacts and the speed at which the Omicron variant moved almost synchronized across North America and across the global economy, again, save for Asia so far, kind of caught a lot of people by surprise. I think too that we're all sort of hearing in different ways and forms the different supply chain impacts that this is having. Hopefully, and from what I've been reading over the last few days, a lot of it does seem to be transitory. I know that word has its own connotations now too, but the impact of this variant does look to be a little bit quicker in its transitory impacts, and hopefully will emerge on the other side in the few weeks with a much more positive and stable outlook to economic growth. I've also been seeing too and reading quite a bit about production cost inflation. Of course, that's across a wide range of goods, but for a sector who lies right on the forefront of turning raw resources into value-added products, this really is a little bit of a concern. So I want to talk a little bit more about kind of some of the things that we've been seeing, and perhaps a couple of lights at the end of the tunnel on this, or at least a few ameliorating factors. So what I want to show you here right now, this is a survey on a monthly basis of the manager's purchasing index of crude energy. It tracks prices of basic crude products. So here, this is a combination graph that includes things like crude oil, raw electricity from hydroelectric or nuclear sources, natural gas. As you can see here, we really are back in a once in a decade at this point sort of price and environment for some of these crude energy products. There's no doubt that as the prices of basic energy commodities rise, that this is impacting. This has helped drive up prices across the chemical value chain, not just particularly from Canada, but also think Europe, think North America, think Asia and the Middle East. There's a bunch of different pathways to chemical production. Those relying on some of the more aggressive crude energy products, the oil pathways, perhaps the coal to chemical pathways. Everybody's kind of being impacted by this. One of the saving graces within Canada, though, is that the increase in natural gas prices, at least so far, it's still early, and this only goes right now to November, have been relatively muted compared to the increase in prices that we've seen in other crude products, in other things like crude oil, in coal products that have really grown by multiples. The NGL pathway to chemical production is Canada's chosen pathway. As you can see, that's providing a little bit of a buffer here as we've seen crude prices take off. And this kind of extends to, I don't have a good graph for it right now, but for those of our members that are involved with electrochemistry, you kind of see a similar buffeting because of Canada's immense hydro resources in certain jurisdictions, really keeping a lid on some of those costs. Of course, this is just an overview right now on energy costs. This doesn't say anything about perhaps other materials costs, particularly if you're looking at some different types of metals, alloys, and minerals. There has been a wide range of cost increases there. So, just from a pure energy basis, we do have a little bit of an emerging Canadian advantage, perhaps, and just something to keep in mind as we look forward and think about how costs will be impacting member production and the chemistry sector this year. Tied within that too, and tied really closely to production cost inflation, is of course supply chain, and in particular transportation network fluidity. I think we're all very familiar with the supply chain problems that are impacting something like automotive production, whether it's microchips or a bearing, anything like that. We do know supply chains are incredibly stretched right now, but it's not just the the supply chain being out of whack. I want you to kind of think back to what I mentioned about Canada's chemical sector hitting its productive capacity. We're kind of seeing that broadly across the entire economy. In fact, yesterday when the Bank of Canada released its monetary policy report, the governor, Tiff Macklem, was very quick to point out in his press conference that, we just haven't seen supply chains grow. We've seen demand significantly outpace productive capacity when it comes to physical things. We heard that too with Jerome Powell in the United States back in December when the Federal Reserve was going over the state of the economy. So something to kind of consider there. It's really demand, strong demand, that is leading to some of these pressures, not just the supply chains themselves being out of whack. When it comes to transportation network fluidity, though, this is a multiple problems, but also something that we are kind of used to here in Canada. I want you to think back to my first slide there when I mentioned storms with a long tail. Think about the different weather-related impacts that the rail network had to go through in 2021, that we're seeing right now as well here in 2022. Keeping transportation networks moving, keeping things fluid is a constant process. And as we go through 2022, hopefully those types of weather-related impacts recede a little bit, and some of those that are on the tail end, particularly around port congestion, around container shipments, that those start to alleviate, and that really kind of opens up other avenues for Canadian chemical production, or at least allows them to operate a bit more fluidly. The last challenge I'd like to talk about, and this is a little bit tricky, I think it's a good segue to go from challenge to opportunity here, is really Canada's approach to climate change policy and the net zero transition. And I kind of want to dig into this a little bit because it really is some challenges, but also an opportunity. 2021 saw the passage of the Net Zero Accountability Act, which enshrines into law very ambitious targets for Canada's emissions reduction pathways. When you combine the Net Zero Accountability Act with other measures that came out of the Pan-Canadian Framework approach to climate change, what we really saw over the last 12 to 18 months was dozens of different policies aiming to help us achieve these goals. My focus right now here is on the federal side, but we saw programs announced and new regulatory developments across the provinces as well. So really a whole host of materials. And so while it's rather surprising, it is a little bit daunting to see just how many new policies are coming down the pipeline. 2022 started off with 9 different regulatory consultations announced or underway. And this is really just a focus on climate change and environmental protection broadly. There's, of course, many more at the provincial level, but just to give you a flavor, 9 that we're currently right in the middle of consulting on, and some that are moving into the regulatory phase as well. My colleagues here at CIAC are in the driver's seat on those, so if you have specific questions, I really encourage you to reach out to them to get more of a flavor. But just as we think of the challenges, this year we do have updates coming to the output-based pricing system, which of course is the framework program for carbon pricing in Canada. We do know that's going to get tighter, that more emissions will fall under it, and that's something we're definitely keeping an eye on. We do know that on the plastic side of things, at the end of 2021, the government did announce its approach to single-use plastic bans. That is something we're working through that has obvious impacts on the sector. And as we approach more in my wheelhouse, and we'll dig into this in a little bit more, is the government is looking at border carbon adjustments for imported products into Canada to make sure all the goods are truly being subject to carbon pricing, not just Canadian production, but those brought in. So again, you can kind of see how this sets up as a challenge, but within that, there is also opportunity. And so I would point out that as we think our way through this, as we look to some of these very ambitious, but at the same time, laudatory goals around net zero, around decreasing our emissions, I start to see, and I think my colleagues agree with me, and I hope you do too, a lot of chemistry solutions embedded in these goals. I think attracting investment to meet these goals is going to be critical, and that's something that we're really is underdriving a lot of our messaging on some of the on these climate change and net zero goals. Is there's only one way to really get here, and it's via the solutions of chemistry. And what we'd like to see is to make sure that those solutions are Canadian solutions and not just coming from overseas or from our trade partners. We think that, you know, building the investment, building the capacity to have investment here in Canada has got to be a key goal that goes with us. And that's where I think you get into the challenge and the opportunity, and a little bit more to come with that here in a second. So now that we've kind of wrapped up some of those challenges and I've sprinkled a little bit for you on the opportunity side, I'd kind of like to circle back and just go, what really are the opportunities? Well, the big one here is continued strong economic growth and broadening of that growth as COVID recedes. Now, knock on wood that is the case, but as we get back to a more normal system, as we get back to a more normal day-to-day operations, and hopefully as we get back into traveling a bit more, we're going to see that, you know, some of the strength that we've seen in those fully recovered from COVID sectors really trickles down to those that were more heavily impacted. As noted, positive trade linkages too are a huge benefit to the sector. That strong economic growth in the United States, Canada's chemistry sector is positively impacted by that. More than 75% of our products are in fact exported, so a strong economic backdrop in the United States, improving transportation and logistical outlets from the United States and from Canada. These sorts of things will really help pull the sector back up into full operation. And as we think through some of those cost impacts that I mentioned earlier, we might even see the outperformance of the Canadian chemistry sector owing to our low emissions and very cost-effective production pathways. As the price of different crude commodities increases, I think I saw earlier today that crude oil managed to hit its highest level since 2014. You know, the backdrop to North American chemical production and Canadian chemical production specifically, those cost advantages are our wealth of resources and feedstocks hopefully will really shine through, especially as some of these supply chain and transportation bottlenecks start to ease. And finally, as I kind of mentioned before, new investment is something that we're really keeping an eye on too. And this is something I actually want to dive a little bit deeper into. I've touched on it a bit, but just to really kind of set the stage for what could be a really positive set of announcements for the year. As I mentioned, 2022 will see 2 world-scale investments and a couple of significant other expansions from members come on at their sites. We're very excited to see Nova and their expansion in Cherniak, for that to come online. Interpipeline's new propane dehydrogenation and polypropylene facility, that is due for startup. Dow Chemical is now fully running an ethylene expansion project that they completed in the fall. And I've noted a couple of members too, very recently, perhaps even last night and this morning, announced a few biannual turnaround sites at facilities in North Vancouver and near Medicine Hat that will hopefully provide years of reliable production once those are done. So some really big investments are coming due, and if you are really going to start to raise the productive capacity here as things move on. But throughout the COVID pandemic, we actually saw more than 9 announcements for industrial chemical projects in Canada. And this is something that, you know, for me, when I first joined CIAC about 5 years ago, one of the big discussions we had was that at the time, Canada had been missing out on the wave of investments that had followed the shale revolution. The United States had been receiving the vast majority of its share, and Canada hadn't quite caught up to what its historical share should have been. Now, I'm not saying we're there yet, but the last 18 months has seen a series of announcements in some really cool and really world-leading projects too. We saw Nautical, a CIAC member, looking to move a blue methanol facility, in Grand Prairie. That is looking to take the next step forward. We saw at the end of 2021, Dow Chemical announce a multi-billion-dollar, multi-year project to take its Fort Saskatchewan operations down to net zero. And that's really exciting. We've even seen companies in Quebec, as Quebec looks to take advantage of the electric vehicle value chain. There's been a host of announcements in the Bécancour area to start digging into, to start getting into those value chains. Think of hydrogen and others there. So some really exciting projects. And I think that's kind of where we line up with, again, you can look at climate change and net zero as a challenge, but it can also be a very strong opportunity as well. We know investment attraction is competitive. We know Canada has done some very good things, both at the federal level with the accelerated capital cost allowance and coming up here in budget 2022, the carbon capture, storage, and utilization tax credit to win some of that investment. We've seen provinces in Alberta, the Alberta Petrochemical Incentive Program, and in Quebec, their approach to, again, the electric vehicle value chain, but also specific industrial innovation sites, again, around Bécancour, to really put in place the frameworks to drive investment. And as we go through 2022, we hope Ontario can get behind these sorts of announcements as well, and we can make this really a whole of Canada approach. But and to bring it all the way back, that's kind of a few of the really good things we're seeing on that. We're seeing companies start to focus on these low carbon investments, lower emissions or energy or emissions competitive investments. And we're seeing some of the things that Canada's put in place. Its price on carbon, the regulatory framework at the provincial level around carbon capture and storage, and then some of the broader tax-based incentives, really making Canada a competitive jurisdiction. So to take these from the drawing board to getting them to getting ground broke, that's what we're looking to see in 2022, and hopefully more announcements to add to the growing list of people that see Canada as an investment jurisdiction. And I guess I would flip that back. The second polling question of the day. I'm quite excited about some of these initiatives, but it's not just for me to be excited about. We need to know, is Canada creating the right conditions to attract new investment to meet our climate change goals? Are there things that are missing? Are there things that could be changed to make it stronger? I put that out to you. I asked, what more could Canada be doing to drive these investments, to get these investments here in Canada versus seeing them outside? And with that, I think this is kind of where we recap for the day. So for the outlook for 2022, I'd just like to kind of reiterate that the continued emergence from COVID-19 is, of course, underlying all of the assumptions and all of the analysis you heard today. I think the best thing that I've learned over the last 2 years is don't get too high when things are going well, and don't get too low when things are going bad. So expect the unexpected with COVID, but as we move towards a more normal life through this pandemic, as we start to see things turn endemic, as we get back to the normal economy, I think that will really bring a new sense of demand and optimism to some of those sectors that haven't quite picked up. The economic tailwinds here in North America are quite strong. We can see that in the numbers that have come out very recently and what's being expected down the line. Consumers are ready to take up the time that's been missed over the last couple of years. So good to see that strong economic tailwinds are moving on. The investments coming into operation here in Alberta and Ontario are going to lift the total productive capacity of Canada's industrial chemistry sector. So that's exciting. We're hoping to see some of the investments that are currently on the drawing board move to the construction phase soon. Hopefully here in 2022, we see a few more final investment decisions to really get moving. And with those thoughts in mind, again, we expect sales growth of around 3 to 7%. Exports should track that closely. Again, depending on pricing, it could be a little bit more, a little bit less, but we're seeing strong demand across the value chain, and hopefully a little bit more stronger demand as we get towards the end of the pandemic here. That is what I'd like to share with you today. I appreciate everybody taking the time to listen to me chatter. Again, I would note that this is just one presentation of things, but I encourage you to take a look at the 2022 outlook for industrial chemicals. That's up on the CIAC website. We're going to promote it a bit more in our next edition of Chem News in a few weeks, but please take a look through that. And as always, I would appreciate any comments, concerns, criticisms, of course, if you may have them. And I look forward to answering any questions or comments you may have in the time we have remaining today, and as we go over those poll numbers. So thank you very much.
Okay, so thank you, Dave, for sharing those insights. I really liked how you kind of highlighted both the challenges and the opportunities we'll see in the year ahead, so we can really keep these top of mind. So now we'll shift to the Q&A session, and maybe I'll just ask if you want to start with the results of the poll question.
Yeah, I think that'd be great. Particularly, I'd love to hear if members think that we're on track with our estimates, or if we're a little bit off base. So, polling question 1.
So you should have it up on your screen, hopefully. I'll just give you some time to digest the results.
I can't actually see them.
Oh, well, maybe I'll just read it out loud.
Sure.
So in terms of where members are foresee their own sales versus 2021 levels, we have 58% saying slightly better, so up to 5% increase. Next was 19% felt significantly better, so 5% or more. 12% said flat. 8% said significantly worse, so more than 5% decrease. And then 4% was our smallest category with significantly worse, so as low as 5% and lower. So I think these are pretty good results for the poll. Most people are saying slightly better or significantly better.
Yeah, and you know, I think that kind of lines up. I'd be very curious in one-on-one conversations if you'd like to share with me some of your thoughts. I would appreciate that too. But I do think that kind of lines up with the different readings that I undertook when we put together this forecast. I do think that as we emerge from COVID, and as particularly supply chains, even though they might be running up against output capacity limits, at least you won't have the continual disruptions, hopefully, over 2022 that we saw in 2021 and 2020. So I do think as those sorts of things normalize, particularly on the transportation side of things and port congestion, if we can get those links moving a bit more fluidly, I do think that would probably help everybody's cause of getting back to normal too.
Okay. So shifting into the second question, I will try to share the results again, but if not, I will just read them out if you can't see them. So in terms of investment conditions and are we creating the right conditions to meet our climate change goals, we had a tie with for the top answer, with 36% saying maybe and unsure. And then we also had a tie for second place with 14% saying yes and 14% saying no.
Okay, so kind of right in the middle there, and you know, I do think that again kind of fits with how we characterize things too, as that entire field, the entire policy field of climate change and net zero being both a challenge and an opportunity. I do think on, at least in public messaging, and perhaps just given the speed at how fast a lot of these consultations come, it definitely does feel like more of a challenge. But as we move forward here, as we see what the government's set to do with budget 2022 around things like the accelerated capital cost allowance, around the CCUS investment tax credit, I do think we can start to see a few more carrots emerge in that regard as well. We do know that provincial governments are constantly tweaking programs, constantly looking at new ways to drive investment into their jurisdictions. So I know I didn't focus as much on provincial jurisdictions as I probably should have in this outlook, but seeing what comes out of provincial budgets too here in the next few months, I do think we could start to see some carrots emerge. And then too, when you add in the economic backdrop and emergence from the pandemic, I think we could really start to hit our stride this year when it comes to seeing, you know, more certainty to make these types of long-lived capital-heavy investments take shape.
Okay, great. So I guess at this point we will shift to the questions. And I note that we're discovering more and more about the technologies available to us even today. So it does appear that the audience can raise their hand to ask a question, and I can unmute you so you can say it out loud. So I'll try to flip back and forth between written questions and raised hands. But just to start, I'll begin with a question from Bob, which is, as Europe's chemistry industry struggles under the weight of challenging energy and climate policy and pricing, are there improved market opportunities for Canadian producers under the new CETA trade agreement?
I would think so. I mean, you know, over the last 6 months, really, like Europe's economy has ran into very serious energy challenges, and everything I've read at this point doesn't anticipate those will get easier in the coming months. That's not to say even anything about what could happen with the Russia-Ukraine situation. Just as crude prices, you think back to that graph I mentioned, you know, I think Europe's moving into much more of a high-cost environment, and that's where Canada's cost-effective pathways, our NGL pathways, and our resource base that we can rely on really do open some doors. I think a big question on whether or not we can really get into those markets is whether or not these logistical issues can sort of be moved from a headwind into a tailwind. The last time I checked, shipping constraints were still pretty severe, even on North American to Europe routes in a lot of cases. So I think as we start to see trade flows normalize ever so slightly, as we start to see ships and containers get into places where they're needed, I definitely do think there could be an opportunity for cost-effective chemical production to get into those European markets, especially under the framework we have with CETA.
Okay, great. So shifting to the next question, and again, feel free to add more and raise your hand because we have lots of time to respond to those. So you mentioned that a strong economic backdrop is making you confident for 2022. Is there any risk to that outlook?
Yeah, yesterday was a big set of announcements from the Bank of Canada and the Federal Reserve. So whenever you go from monetary policy shifting from extremely accommodative to less extremely accommodative, there are risks there. I think I'd already mentioned too that most people believe we have hit the peak of economic growth coming out of the initial COVID lockdowns. But I would kind of go back and highlight just how strong and perhaps how resilient demand is in front of some of these headwinds. I was reading the other day that a few banks have estimated that North American auto production is, the demand is about 2.5 million vehicles ahead of production. Obviously, that is good news if you're looking to, if you're looking for a tailwind for demand in certain things. We see that as well in things like housing, in demand for durable goods. Of course, the big question there though is, can supply chains catch up with that? We're well aware of things like computer chips and microprocessors, something not directly related to chemistry, but the impacts there and the productive capacity of those sectors to meet demand. I think that's probably the biggest risk, is that simultaneously in a bunch of sectors in a way that perhaps I don't know what examples would be good to draw to, is that you kind of just you run into capacity problems across the board. I think that'd be the biggest risk, is that we don't end up overcoming some of those supply chain problems. We continue to run behind or have issues. I don't think that'll be too problematic for certain sectors, particularly in building materials. I think there's more room to increase in a shorter amount of time to get things moving. But for some advanced products, for very highly technical manufacturing products, there definitely are risks on that front, yes.
Okay, now shifting gears, we have another question from the audience. So your review of challenges did not state labor challenges or, labor shortages or challenges. Clearly, this varies depending on the province we're speaking of, but do you see this as a big challenge or risk in this industry?
I should have definitely highlighted that. I end up putting labor in supply chain issues in my head, and I definitely should make that a bit more apparent. I think Canada's in a little bit of a tricky spot just because compared to the United States, it took so much longer to fully reopen things. I don't know if we have a great picture on the labor situation in Canada. We do know that demand has run ahead in certain skilled trades. We are now, I think, very aware of issues in the trucking sector for crews there. So I do think there are pockets of things that we have to watch carefully, but it took so long to almost reopen, and in a lot of cases we fully haven't yet, that I think that's still a bit of a cloud. It definitely could become an issue, particularly if people have moved on from some sectors. And there I'm kind of thinking natural resource development, where because of several year-long tough markets that people have maybe decided to move into different careers at that point. I do think you'll probably see pockets of that popping up for sure, and it is something to keep an eye
on. Okay. So you also mentioned that pandemic trajectory, and I was wondering if we could go back to quote unquote normal. What will that mean for your outlook when it sounds like abnormal is what drove last year's performance?
Well, it's tough to say. I think what normal would probably do is maybe a slight moderation on some of the subsectors that truly outperform. But at the same time, I would also say that there were so many unique factors, particularly the weather-related impacts, and I can't stress enough the combined impacts of the winter storms in February 2021, the hurricanes in the fall. That really did tighten up a lot of product markets, and really did lead to a lot of, at least some of the pricing related impacts that we saw. From what I've read from publicly available information from some of our member companies, but also global companies in this space, is that demand does remain extremely robust on a physical basis. So you might see a little bit of pullback in that regard, but that should also mean that, as people get more into the office, as I finally get to print things off instead of just reading them on a screen every second day, that we do see some of these subsectors that did underperform kind of gaining strength and getting back to a normal level that we saw kind of a few years ago, really, before we ran into some of these bigger issues. I think as we get closer to normal, it'll really be a rising tide that lifts all boats in some cases. It will be worth watching as the data starts to roll in the coming months to see if we do see significant slowdowns. But from what I've been able to glean so far, underlying demand for across the chemical value chain seems quite strong right
now. Okay. So before jumping into the next question, I'll just remind the audience that you can raise your hand and ask a question, have your voice heard if you want. But again, the question tab also works. So I only have one question left. So if you want to squeeze some more in before we wrap up, then feel free to put your hands up or write them down. So you made some interesting points about cost inflation. Could you expand on that a bit more? It seems like that could be a downside risk to your outlook.
Yeah, this does get a little bit tricky because basic commodities, whether it be resins or in basic chemicals, generally do quite well from a sales standpoint as prices are rising. There's a tug and pull effect there, and I think kind of underlying that too is a lot of the strong demand we're seeing. So there's a couple of good tailwinds in that, but of course something that rising costs, particularly in the materials side of things, do lead to margin compression. And that, of course, leads to discussions in corporate boardrooms about which operations are performing the highest level and which are performing perhaps a little bit tough in that sort of environment. I would kind of go back to just the overall picture of Canada's natural resource endowment and the pathways we've chosen in that regard. They are among the most cost effective, at least from a feedstock perspective. So that is definitely a tailwind. Members and processes, though, that do rely on imported products or perhaps on input materials that aren't just crude energy, that are from the metals and mineral space, there are definitely some headwinds in there. Demand across the metal space, I think, has been even a little bit more intense and wild and volatile over the last 6 to 9 months. And so I think planning in that sort of environment is definitely a lot trickier. And I think that'd really be the takeaway. It's just that things are moving on price-wise so quickly, and production processes obviously move a bit slower. It's just, I think planning in particular, this is a very difficult environment for that. Whether it's on, your feedstocks and your input materials, or on things like transportation and logistics. When companies need to make up revenue, whether that be due to slowdowns in other segments, I think kind of planning for that, planning on being able to move your product through a port in a reasonable time, those are challenging right now. Hopefully they'll become less headwinds as we move through this, and as transportation companies in particular are able to get their workforces back up to speed. But that's, at the moment, definitely a headwind, hoping to see it turn into a tailwind over the next few months, especially as we get out of the winter season and into normal operating conditions for Canada's transportation system.
Okay, thanks, Dave. So maybe we'll just close off with one last question. And of course, we couldn't finish the webinar without talking about plastics. So how do you see the role of recycled content suppliers in the market and the pressure from virgin resins for the reprocessed resins in the upcoming month?
Could you repeat that again? Sorry, I think I missed a chunk there.
So how do you see the role of recycled content suppliers in the market and the pressure from the virgin resins for the I'm guessing it's reprocessed, but I might be wrong, resins in the upcoming months?
Yeah, I think this is a very interesting space. I've been reading a little bit lately that because of a lot of the commitments made by brand owners and consumer goods companies, you're actually running into a very similar problem that we're seeing now. The productive capacity of effectively getting recycled resins from discarded streams back into brand owners' hands is becoming a bit of a problem. So I think in that sense, you kind of run into a lot of the same issues that we've been discussing today, particularly on supply chains and, of course, security of supply in that case. But it's also a matter of really starting to get more investment, I think, into the recycled resin space to drive the next step up in order to increase supply. That's something that I think a lot of commitments have been made in a short amount of time, and I'm not sure yet if the capacity to scale up that recycling at cost and at scale has taken place next to it. So I think that'll be something to keep an eye on as we move through 2022, is are we starting to see the investments in recycling keeping pace? Are we starting to hear that, that recycled resins at volume are making their way into the supply chain? That'll definitely be interesting. We do know too that in Canada specifically, that virgin resin capacity is about to get a big step up here with Nova's investment. So there's going to be markets for both. I think that's the way to look at it. I would put a little bit of pressure, I think, on the recycled side to see if we can start getting more capacity involved and more investment to kind of scale up there, because I think that's probably going to be your short to medium term problem in that space.
Okay, so with that, I think that's all the time we have today. So I'll just say thank you once again to Dave, and thank you all for joining us and participating. So I hope this webinar really resonated with you, but if you'd like to dig into the material a bit further, please check out CIAC's 2022 Outlook report, which will be released on our website today. I believe it already has been released, and it will also be featured in the next edition of our Chem News newsletter. Also, a recording of this session and copy of the presentation will be shared with participants, so look out for that by early next week. Please also look out for our next webinar focused on cybersecurity in industrial control systems that will be delivered in partnership with Public Safety Canada. So before we wrap up, I just maybe wanted to pass it over to you, Dave, for any final thoughts.
No, I would just like to thank everybody for their time today. Hopefully you took some value out of this. I really enjoyed putting the Outlook together. It allows me to kind of cast a very broad net and tap a whole bunch of sources to find out exactly the markets that you as members are serving and also how operations are going. So hopefully what I've spoke about today reflected what you're seeing on the ground. And as always, I'd love to hear your comments, criticisms, and any thoughts you could have to make this better. So please don't hesitate to reach out. My contact information is at the end of the Outlook itself. And I'd be happy to chat with you at any time at your convenience. Thanks again for your time today.
Excellent. Thanks, everyone, and have a great day.